So you see all these ICT guys rinsing prop firms for profits lately, right? Jade Cap 2.5 million this month, which is a record-breaking month, by the way. Lanto, top of the leaderboards on Apex. Brian Stong, 6 figures every month. Yours truly, Court Currency, six months of consistent payouts. What are these guys all doing differently? With a plethora of ICT entry models, which one can possibly work for you? And what is the difference, rather, so you know which one fits your personality? Because that's what it is at the end of the day, making the trading style your own. At the end of the day, you're either entering early for optimal entry or sacrificing the optimal entry for trade confirmation. Okay, that's what it all boils down to. So just make sure you stay to the end of the video, because I'm going to show you the pros and cons of all these entry models, how you can have the patience to wait for it, how you can notice it when they appear, and most importantly, how to pull the trigger when you actually see it. Okay, and maybe the very most important thing is the context that goes along with these trading entry models, which is the prerequisite for any trade. Okay, so stay tuned, and we're about to get into it right now. Now, before I get into all of the models, there's two things you need to know. Number one is, why does the market move? It moves either to hunt liquidity, engineer liquidity, or rebalance inefficiencies. Okay. The second thing is, what is the whole reason? What is the whole importance of spotting liquidity? Okay. Now, smart money, and when I say smart money, I mean the big players, the institutions, the hedge funds, the algorithms, right? They can't just enter anywhere. They can't just say, okay, I want to buy up this market. Let me go over here. Okay. Anyone who's ever tried to put on 20 contracts in a live account, you see that it's not just easy to fill that. So imagine millions of dollars being managed trying to just fill in it. They have to go to manipulate price to areas, common areas where traders have pending orders. Okay, so if they want to buy the market, right? So if they're trying to buy the market, they can't just go up. They need to manipulate down, because you have stops over in this area. They need to manipulate down, hunt those stops, and then they can finally go in, because that's going to fill their contracts. All right. If I was previously in a buy here with my stop orders here, right, that means I have a sell order, and the smart money is trying to buy. So they would trigger my stops, which is the sales for the other side of their buy contracts. Okay, because this is a zero-sum game. You need equal, equal amount on each side of each transaction at a specific price. Okay, so that's why liquidity is important. All right, so let's get into it. So before I get into all of the models, because we're gonna go over one trade, but all the models in one trade. But as I told you before, context is the prerequisite for trades. All right, so it's 9 o'clock now. New York, right before New York Open. Before I even worry about taking a trade, I'm gonna draw my outline. So I need to box out the Asian range. So Asian range is from 6 p.m. to midnight. Some people draw different ones, but it's 6 p.m. to midnight. All right. That from the high to the low. Asian session is characteristically a rangy session. It doesn't really have a definitive move. It's really the accumulation phase. Okay, but I boxed that off because you see first the session high right here. All right, and that's what we're looking for. We're looking for these session highs. You have the session low here, but that's really insignificant in this manner because it was already taken out. All right, so aside from that, you have these internal highs. Right now, the reason we're marking these off is because this can possibly be a draw on liquidity for price to go to before it goes in the other direction. right? Those are all to the upside because price is right here. These are all price can possibly take out this, go up here, take out this, or take out this, even though it's a little far away, just to take out maybe these equal lows right here, or even go further down and maybe wants to totally dump and go all the way down here, right? So we're just drawing it out just so we can see it on the chart. So when price takes it, we need to look for a reaction. These are equal lows here, or relative equal lows. All right. And now we're in replay mode, so I'm gonna start the market off, and we're gonna see what price wants to do. All right. So we got 9:30. Okay. First, let's pause it for a second. 9:30, price took out buy side liquidity here. All right, which is internal liquidity. So let's see what it's going to do afterwards. Now we got 10 o'clock. And I like 10 o'clock because that's when the next 4-hour candle starts. Okay, so it took out these equal lows down here that I marked out. So let's begin with the entry models. So first what we have is the turtle soup. Okay, so the turtle soup, we took out the highs, immediately went up and made a swing high. Okay, so you want to at least wait for a candle to print and then you enter. Now the turtle soup is all about optimal positioning. Okay, so and kind of what I went over earlier, the different type of traders, you either want optimal positioning, so you're entering early, or you sacrifice that optimal positioning for price confirmation. Okay, so you may not get the best price point, but you may have a better win rate because you're confirming the price wants to go the other way. All right, so this is the early positioning, the earliest positioning. All right, so we're gonna go for hopefully the market lows all the way up to the session highs, Asian session highs, which is a 5-to-1, by the way, 5-to-1. All right, very important, very good. All right, now next we can possibly have an inverse fair value gap. All right, where we will wait for price to close on the other side of this gap. Okay, where we would enter there, and if price comes back and closes on the opposite side of this gap, we're out of the trade. Okay, after that, another thing that we can wait for, being that a swing high was already printed here, now if we get another low and then it closes now above this candle here, that is a change in state of delivery. Okay, so we're already in the turtle soup. We're now waiting for the change in state of delivery or the inverse fair value gap. All right, so let's go ahead and play this some more. Okay, now we don't have that change in state of delivery or the inversion yet, but what we do have now is a breaker. All right, so let's draw the breaker. The breaker is, we have a low, okay, we have a high followed by a low, and then a high. Now this is not validated yet because the high, it did not close outside of this breaker yet. Okay, but this is the start of it. Okay, the order block was formed and then broken, invalidated by this making a low here, but now it's starting to go up, and after this whole context of it taking out external liquidity. Okay, so let's play it some more. Okay, the breaker is confirmed. Okay, so now what happens with the breaker, you will quite often, especially after liquidity is taken out, you would have displacement there, and whenever whenever you have a fair value gap because displacement overlapping that breaker, we have a unicorn model. Very high win rate, very good model. And you have, especially once again with the context, all of these models have to go with the prerequisite of context. It is a great win rate, and you have the confirmation, and you see that you have the change in state of delivery. But you do want to pull back on the change in state of delivery. But as far as the breaker, we're going to enter this breaker now. Okay, so we'll enter this breaker. I'm sorry. We'll enter that, and we're going to put our stops beneath the breaker. Okay, so we don't want to see price come beneath this breaker. All right, which it should not do. Breakers tend to hold, especially when it's a unicorn. All right, so we're still waiting on the pullback for the change in state of delivery and the inverse fair value gap. Okay, boom. We have now price closed on the opposite side of this fair value gap. It's now an inversion. All right, so we're in the fair value gap. All right, so with the fair value gap, it's like I said before, it's a soft stop underneath the gap. So if it closes underneath this, it invalidates it. We stop out. But if it comes down here, but then closes within the gap, the trade is still valid. All right. So I'm sorry, with the fair value gap, we're still at a 5-to-1 with the inversion because of where we're putting our stops, and it's actually the same risk to reward as the turtle soup. And the turtle soup got stopped out, by the way, and that's the risk you take with the turtle soup. You get optimal positioning, but because there's no confirmation, you can't get stopped out. That's the risk you run. Okay, but you know what game you're playing. All right, so let's go further. Oh, and I'm sorry, I told you to stop with the fair value gap, but not the inversion. Okay, I'm sorry, with the inversion, but not the breaker. So this is the breaker. Okay, this is the breaker. All right, so price is gonna be your stop is gonna be underneath the breaker, and with the breaker being a 2-to-1. Okay, the breaker is a 2-to-1. So a little less risk to reward, but still a safe trade. And you also have here BPR. So the BPR stands for balanced price range. All right, that is when two fair value gaps overlap one another. Now, it's not really meant to work on lower time frames. It's better for the higher time frame, 1 hour gaps, 4 hour gaps. But for the sake of this, this exercise, I'm showing you all of them. Okay. And as you see here now, the BPR was stopped out, but the price did not close beneath this inversion. Okay, so the inversion is still valid. So far the BPR got stopped out, the turtle stoop got stopped out, but the inversion, breaker, and the change in state of delivery are all good. And if you're in a breaker, you're also in change in state of delivery. It's all confluence in the same thing. All right, so we're going into the afternoon with this one, past lunch. Now it's 1 o'clock. And boom. All right, price made it. And and a hint that you got in for the move was that immediately after liquidity was taken, because after it got the liquidity from sell side, it's targeting the opposite side, buy side. Okay, so right after that, you see the sell. They obviously sold out of their contracts, and if you got in this trade, you participated in the move of the day. And as we saw, the turtle soup didn't work out, okay, but you also wasn't stopped out for too many points. The inversion gave you the opportunity, because of the stop wasn't all the way at the bottom. You're anticipating that inversion to hold, so your stop is beneath the fair value gap. We got a 5-to-1 on that. We got a 2-to-1 on the breaker, and the breaker and this chain of state delivery. So all in all, good trades, great trades, which aligned with the context, that we wanted liquidity to be taken out to go to the other side, because we know that big money needs to draw liquidity for one side to attack the opposite side. Okay, so comment let me know in the comments, what is your best entry model, what works for you, and what was your favorite that I talked about here. Feel free to watch my other videos. I go more in depth on my channel about breakers, fair value gaps, and all the above. Okay, so like this video and make sure you subscribe.